Hi, I'm Claudine Cohen, Managing Partner of Value 360 at Cohen Resnick. Welcome to our current episode of Dealmakers Unplugged. With me today, I have Nicole Pereira, Managing Director and Head of Portfolio Management at Lafayette Square. Nicole, welcome. Maybe you can quickly just give some background about you and we can get stuck in.
Yeah, absolutely. And thank you for having me, Claudine. I'm excited to be here. Let me give you a bit of background about Lafayette Square. We have a private BDC that we invest out of with about 1 billion in assets and growing. The majority of our investments are senior secured loans to middle market companies with strong historical track records. We diversify across industries into defensible business models. And we have a primary focus and have built processes and procedures around investing in non-sponsored businesses, or as I like to call them, founder, family, and entrepreneurial owned businesses. And lastly, I always love to mention this. As a BDC, we're mandated by the 40 Act and the Small Business Investment Incentive Act of 1980, and we take it very seriously, and we do provide significant managerial assistance to our portfolio companies.
Great. And we're going to talk a little bit about all of those things. So maybe just on the non-sponsored lending, which is a big piece of what you do. Can you maybe just talk through, why the focus there, where the opportunity is for Lafayette Square, just given your mandate, the type of structuring you do, and why it's a good fit?
Besides being fun, besides having a passion for investing in founders and family owned and entrepreneurial owned businesses, the non-sponsored space has a large addressable market. So if you look at the universe, and we have the data, if you look at the universe of middle market companies, there's about 250K middle market companies that employ Americans. About 175,000 of that are middle market companies in our addressable market. 80% of that, of those companies, are non-sponsored companies. So, there is significant white space. And to just put it all into perspective in comparison to BDCs out there, BDCs invest in about 7,000 companies out of that addressable market. So when you put the data together, there's a huge white space, and we've been able to penetrate this white space pretty well. And we've been able to help our investors diversify. That's a big part of it here. There's a good amount of overlap with portfolio companies in BDC structures when you're talking about sponsor only deals. So we want to diversify for our investors even further by investing in non-sponsored deals. I guess number two is, tight credit structures, right? We mostly invest in, as I stated, first lien senior secured debt. Um, the credit agreements we are able to structure investing in these type of loans to non-sponsored companies have tight definitions, a minimum of two covenants we require. There's always a leverage covenant and a coverage covenant. There's incurrence tests if there's a DDTL. There's conservative restrictive payment terms, minimal leakage, and on average non-sponsored deals are typically lower leverage. And what we find here in this market is there is a competitive risk adjusted return and competitive spreads. And another fact that I love is there is beneficial alignment of interest, as the ownership is typically intact.
Yeah, and I mean, I would imagine, like, unlike a lot of the sponsor-backed deals, where the sponsors come in with their 100-day plan and their value creation plan, and they're professionalizing these businesses. These non-sponsored deals, I mean, you've got the founders, the families, can be scrappy. So having that additional discipline around assessing them is important, and having a higher risk adjusted return. I mean, because in some respects, there's a lot more risk. In other respects, maybe not as much risk, but I suppose you have to weigh it up. And it's a great niche because with baby boomers and just a lot of these businesses not having great succession, but the owners not willing to let go yet, it's a great opportunity for them to take capital invest and continue to grow the businesses with a view to an exit later. I'm curious to find out, like, so you mentioned it's a big universe. Where do you find these? And, when you do eventually go through your diligence, I'd love to hear a little bit about the diligence process and some of the criteria. But, you know, are there strict parameters once you've given the green light as to this is what the capital's got to be used for?
Yeah, great question. And I'll start with, how do we find these businesses? So, in actuality, a lot of these businesses, they have audits, they have a finance function, they are disciplined in that way. They are banked typically. They typically have some sort of capital provided by possibly a commercial bank. They may have a revolver. And these businesses are typically looking for to grow. It's typically a growth aspect here, whether they want to acquire another business or acquire tuck-ins and make certain tuck-in acquisitions to grow their business. In certain cases, and this is also growth related as well, they want to refinance out a lender that can't grow with them. Maybe that's a commercial bank, so we get involved there. Or there's also succession financing and ESOP financing as well. So we offer a non-dilutive solution to that to owners that just aren't ready to sell to private equity, or they may want to keep their business for their children or their employees. And many times these owners actually feel that they have more growth under their current stewardship, and just need a more flexible partner, and a partner that understands how to invest in the space besides a large bank. And in order to find these deals, you really have to have a good origination team and process in place. The sourcing is a bit different than traditional sponsor deals. You need experience, and you need boots on the ground regionally, and experience dealing with the local business communities, accountants such as yourselves, uh, lawyers and bankers in the state and regional areas. So we have boots on the ground for coverage, and we utilize and integrate technology to find these companies into our processes. I'm not going to call someone up in Louisiana from New York and say, "Hey, I want to finance your business." There's a more trusting relationship that we can grow if we have someone from the region or from Louisiana itself on the ground, able to go meet, understand these businesses. And also it de-risks us as well, because some of these originators know some of these business owners in the area, and they've been around for a very long time, and it enables us to get a good background sense.
Yeah, look, I mean, there's nothing better than that kind of relationship building in person and getting to know people. And I think you're right, especially in this community. If you've got people that are boots on the ground, it makes a big difference and part of the community. From a diligence perspective, I mean, when you mentioned that a lot of them are audited, they have some discipline in that. I wish we would have those ones when they come to us and our clients are buying them and they would need a Q of E, because most of what we see is at most maybe reviewed financials, typically compiled financials, cash-based financials, owners like running a lot of the businesses, even like businesses of significant size, just running them like it's a personal checkbook, and a whole host of issues that we have to deal with from a diligence and getting to a good normalized EBITDA. So, I mean, when you are diligencing these businesses, what are the things you look out for? What are the no-goes, and how do you ultimately get comfortable?
Yeah, we run a very robust process. Just as you need the right originators and processes on that side, you need the same with underwriting and execution. Look, and Claudine, we've used your services. We commission third party studies, even if we have audits and we've seen reviews and all that good stuff. We get all the internal information, we take that in, but then we also get that commissioned third party study, the Q of E's. We need to identify, how they're coming to EBITDA, the EBITDA add backs, the cash reconciliation is extremely important. the working capital aspects of the business are extremely important and difficult to model. And, it can change the outcome of a business and free cash flow if you don't get that right. We also commission market studies. And these market studies, help us understand where the companies sit in the market, what their competitors look like, how big the actual market is. And they do customer calls. We do internal customer calls as well. Our team calls the top customers of these businesses. We do background checks. So we do utilize a lot of third party studies. We always have to have a Q of E, even if we have an audit, even if we have top 5 accounting firm audit. Q of E is mandated. Internally, we utilize technology to maintain processes, checklists, real-time updates on industries and regulatory environments, depending on what type of company we're dealing with. We go in person, multiple management meetings, multiple calls with understanding, reviewing the Q of E's with management, reviewing the market studies, everything. There's a longer process here. It's not the typical 4-week process of closing a sponsored deal. It's more like 4 to 12 week process of doing full private equity diligence. That's why you need the right team. You need the leaders who are leading that team to have invested in non-sponsored deal before. I've spent my entire career investing in primarily non-sponsored deals, and so has the leadership at Lafayette Square. So you need, and you learn over time what the best practices are, what the right processes are. And then you need, lastly, you need a portfolio management team to monitor the credit. Because, once the deal is made, especially if you have a DDTL or incurrence tests, and especially like you said, some financial aspects of the business may be a bit immature. And we also refer, FP&As to go in the business and analyze their financials even after we've made the investment to help them, provide financials more efficiently and the way that is, sort of legible for a lender as well. And we continue to monitor the business closely, check every number, check every covenant. So it's a very thorough process. And internally, we need amazing communication. We have preview memos and meetings. We have numerous subset meetings before anything gets to our final investment committee. We've spoken probably at least 5 to 7 times on different meetings. And once you ask one question, it sparks 5 more questions that are deeper.
Yeah.
so
Yeah.
so it is an onerous process. There have been deals that have taken weeks to get done because you need to get the answers to be able to close the deal.
Yeah, you brought up a good point. I mean, you are looking at it as if you're a private equity investor, because when you get a sponsor back deal, you get the package, the Q of E, the market study, all these things. When you're looking at non-sponsored deals, it's up to you to do all of that. So one of the things that's a little unique to the BDC community, and it comes out of, it's mandated through the Investment Company Act of 1940, and that's providing some managerial assistance to portfolio companies, which, I mean, private equity funds will tell you they have an operating partner model, but I think in the case of debt and not, taking not a buyout and a majority ownership, this is quite unique.
Yeah. So we take this mandate very seriously, and it's even been updated to the Small Business Incentive Act of 1980, which mandates that you provide managerial assistance, and not only just managerial assistance, significant managerial assistance to your portfolio companies. So once diligence is complete, once the investment has been made, our approach is to speak with portfolio companies, speak with managers, speak with HR reps to adopt programs that strengthen workforce health and financial stability, like, for example, emergency savings programs, credit building services, financial coaching, retirement savings solutions for their working class people. The thesis is pretty straightforward. If we find that these programs help reduce employee turnover, which has a direct impact on the portfolio company's performance. Industries with elevated turnover bear significant costs in retraining, recruiting, onboarding. So to us, workforce stability is, not peripheral to credit quality. It's a large component of it. And what we do is we introduce our portfolio companies also to our affiliate Worker Solutions LLC, that operates on its own platform for identifying and recommending third-party services to clients. And to incentivize uptake, Lafayette Square, the BDC, we do our part. We offer a rate reduction on loans that portfolio companies, if they elect to engage with those resources. So that's pretty, managers, owners, they're very excited about it. They want to retain their employees. They want to find other ways to retain their employees and other offers to be able to, help underserved communities. And we do that through our affiliate there, and we do our part as well through the rate reduction.
That's great. So maybe just like to close things out. So you've held your portfolio company. They're now ready to exit for whatever reason, and it creates a great pipeline for the sponsor community, both traditional private equity, independent sponsors, any investor. But when it does come to exit, how involved are you with the owners, the founders, management in making those decisions, strategizing, or is it really just up to them and as long as you get repaid, that's great?
Yeah, look, I mean, as a senior secured lender, we do not actively manage the business. We can only suggest things, right? So the business, the management team, the owners, they make this decision themselves. And typically, look, we come across owners that if they don't want to sell to their employees into an ESOP, or they don't want to pass down to their children, or they don't have a succession plan, a natural succession plan is to sell to private equity. And, private equity multiples have been going up. So IPO, we deal with, traditional businesses here. Some of them look to IPO. Most of them really don't. They're looking to make an acquisition, grow their business, have us as their lender, and to enable to do that so that they don't have to dilute their own equity. And they want to look to sell typically. And it does create a good funnel for private equity. I should be getting a few calls from private equity companies after this, asking about my funnel. But we do not actively tell managers of businesses that are performing to sell their business. That is totally up to them. If they want to continue to hold on to their business, that's great. Some businesses have a lot of cash flow, and they could actually technically pay us off through that. But it's, you have to have your eyes closed if you don't see this as a natural funnel. And I think, because we've done the diligence of a private equity firm to get the investment in the books in the first place, it actually makes it easier for PE sponsors to then come in and take a look at this company because they've already been through it. The management team, understands that PE will need a Q of E and maybe a market study and all of those things, after a few years of investment with us. And so, yeah, I think it's natural. The
Yeah.
owners will make that decision.
Yeah, look, I'm sure there's also you build relationships, but I didn't realize until you and I started to have this discussion just what an important piece of the value creation um, kind of journey this is for non-sponsored deals because you're providing this capital which allows them to grow, to improve process, to do acquisitions, all the value creation levers that a traditional sponsor would do. And then, that as you say, there's that funnel for private equity, which is great because, private equity has become such an important part of, just M&A, just generally, whether they become a platform or part of an add-on for an existing portco. But, it's really interesting. I never thought of it in terms of like Lafayette, the work that they do and value creation. So anyway, so thank you. This was really insightful. I enjoyed talking to you today. Um, yeah, and I'm sure that I'm going to send some of our private equity clients knocking on your door to find out about that
Oh
funnel.
boy. We love them. They're great. So,
Thank you,
thank
Nicole.
you so much, Claudine. This has been